In 1929, one man stood up against the Federal Reserve when the entire economy was about to collapse, and single-handedly saved it. A man powerful enough to overrule the government, and the nation loved him for it. The newspapers called him Sunshine Charlie, America's most trusted banker, the man who democratized Wall Street, a financial genius, savior even. This is not one of those stories. 7 months later, the stock market collapsed so fast that machines tracking it couldn't keep up. In just 6 hours, Americans lost $14 billion, more than the US spent on the entire First World War. Communication with the stock market was cut off. 25 million people lost their jobs and 9,000 banks closed. 2 million Americans ended up homeless, suicides up 30%. And behind that smile, Mitchell had been selling worthless investments to widows, retirees and school teachers. His own bank knew the products were garbage, and when the crash was coming, he got out. His friends got out. Everyone else lost everything. He never spent a single day in prison. In 1918, the First World War ended. To fund it, the US government had done something that changed America forever. They sold war bonds directly to ordinary people, called Liberty Bonds. Charlie Chaplin stood on street corners telling crowds it was their patriotic duty to buy. And it worked. More than 20 million Americans bought in. They learned to clip coupons and collect interests, and for the first time in their lives, they owned a piece of paper that made them money. When the war ended, those 20 million Americans were sitting on cash and a brand new appetite. But government bonds were boring, small, safe and predictable returns. So now they wanted more. But the stock market was a different world entirely. Only 500,000 Americans actually owned stocks, less than 1% of the population. You needed a broker, connections and money most people didn't have. But one man looked at those 20 million people and saw something no one else did. If the government could teach them to buy bonds, he could teach them to buy stocks. In 1919, Charles Mitchell took control of National City Bank, the largest bank in America, responsible for 25% of all corporate loans in the country, with assets of $2.7 billion, more than the budgets of most nations at the time. To understand the kind of power Mitchell held, imagine if Jamie Dimon and Elon Musk had a baby who ran the biggest bank in America. That was Mitchell, the most famous banker in the world besides JP Morgan himself. And his pitch to America sounded noble on the surface. Why should wealth only belong to the wealthy? So in 1920 he created National City Company, a subsidiary of his bank with one single purpose: sell stocks to ordinary Americans, right inside bank branches. When a person walked in to open a savings account, a salesman was already sitting across the desk, ready to convince them that the stock market was their ticket out. And to sell that dream to millions, Mitchell didn't hire boring old bankers. He built a sales army. If you've seen the movie with The Wolf of Wall Street, you know what a boiler room looks like. Rows of hungry, aggressive men trained to sell stocks to anyone with a pulse. Mitchell invented that playbook 60 years before Jordan Belfort, and he did it at a scale Belfort could only dream of. He deployed thousands of salesmen across 69 bank branches nationwide and connected them all with 11,000 miles of private telegraph wire. Mitchell could flash a stock tip from Wall Street to a housewife in Oregon in seconds. These salesmen were ranked on hit lists. If you didn't move enough products, you were fired. But if you did, the bonuses were enormous, and they had a manual that told them exactly how to break people down. If a teacher or a widow said, "I don't know if I dare borrow that much money," the salesman would look her in the eye and call her timid, small-minded. They told people that caution was a character flaw, that the days of crisis were over, that we now lived in a new era where the old rules of savings no longer applied. If that didn't work, they would weaponize patriotism. Don't sell America short. Are you a pessimist? Don't you believe in this country? Mitchell had turned investing into a patriotic duty. To say no was to bet against your own homeland. And if patriotism didn't close the deal, there was always fear. While you're sitting here thinking it over, your neighbor is making $500 a day. Can you afford to wait? They made ordinary people feel like keeping their money safely in the bank was the biggest risk of all. The salesmen hid behind what they call the National City Halo, the bank's century-old reputation as a pillar of American stability. They weren't some shady outfit on the side street. They were National City, the most trusted name in American finance. And that trust was what made them so dangerous. Mitchell's right-hand man, Hugh Baker, put it plainly. If the public wants to gamble, we will provide the chips. And we will take the house's cut, regardless of whether they win or lose. But a sales army alone wasn't enough. Mitchell needed legitimacy. So he brought in the celebrities. Babe Ruth, Groucho Marx, Charlie Chaplin. If the greatest baseball player in history was getting rich from stocks, why shouldn't you? And the advertising was everywhere. Newspapers printing success stories about secretaries who got rich and streetcar drivers who bought mansions. Mitchell's bank branches were decorated with posters of happy families and expensive cars, the blueprint for how your life should look. But selling stocks wasn't enough. Mitchell needed ordinary Americans to invest more than they could afford, and he knew exactly how to make them do it. In 1920s America, borrowing money was still like a moral sin. Debt was shameful, but Mitchell didn't care. He offered 10-to-1 leverage to everyone who walked through the door. Margin lending. Put down $100, borrow $900 and buy $1,000 worth of stock. If it went up, your returns were multiplied. And his salesman made it sound so simple. Look, Mr. Brown bought Radio Corporation for $500, putting down only $50 of his own money. 6 months later, he's up $150. That's 300% return. Meanwhile, your savings account would have earned you $15. It sounded foolproof, and that's exactly what made it so dangerous. Because here's what the salesman never explained. If the stock fell just 10%, you didn't just lose your investment, you were wiped out completely. And if it fell further, you owed the bank money you didn't have. The leverage worked both ways. It just didn't feel that way on the way up. From 1925 to 1929, margin loans in America exploded from $2 billion to $8.5 billion. And by 1929, Americans owed more in margin debt than the entire money supply of the United States. 10 million Americans, all leveraged 10-to-1. And the whole time, newspapers called Mitchell a financial genius, a savior. In 1928, he earned $1.2 million. In today's money, that's over $20 million. But here's what nobody outside the bank knew. Behind the smiling press conferences and the talk of democratizing wealth, Mitchell was running an operation designed to enrich himself at every turn, while quietly dumping the bank's worst garbage onto the people who trusted him the most. He secretly created a chain of investment trusts, Trust A, B, and C. On paper they looked like legitimate investment vehicles, but in reality they did nothing but buy shares in each other, a closed loop of borrowed money designed to inflate stock prices and generate fees at every turn. Now Mitchell took a commission when the trust was formed, another when it traded, and a management fee to keep the whole thing running. But fees were just the pocket change compared to what came next. By 1927, National City Bank was sitting on millions in bad loans to Cuban sugar producers. Internal memos described the situation as hopeless, but Mitchell didn't want to take the loss. So he sliced the debt into pieces, repackaged those worthless loans as securitized bonds, and sold them to the public as safe investments. He did the same thing with Peruvian government bonds. The bank's own analysts warned that Peru was heading for default. Now Mitchell suppressed the warnings and pushed them onto retirees anyway. Peru defaulted shortly after. Sound familiar? It should. It's the exact same trick that would destroy the global economy in 2008. Mitchell invented that playbook 80 years earlier. But he didn't stop there. Mitchell used his own sales force to pump National City Bank's own stock price. By flooding the market with thousands of small buyers, he kept the share price artificially high. His personal bonus was tied directly to that price. Every customer he convinced to buy was putting money straight into Mitchell's own pockets. But the fraud went deeper than balance sheets. The sales force was instructed to watch obituaries. When a man died, his widow would receive a life insurance payout. Within days, sometimes hours, a National City salesman would appear at her door. He knew she had cash, he knew she was grieving, he knew she trusted the bank's name, and he would convince her to put every cent into bonds the bank knew were worthless. One widow later wrote, "Did you need my pennies that badly to build your towers on Wall Street?" And the salesmen didn't just target strangers. They sold those toxic Cuban bonds to their own mothers, their brothers, their neighbors, people they sat next to in church on Sunday morning. And one salesman finally broke. He wrote to Mitchell directly. "Sir, I can no longer sell these securities to the public. I know what's in the internal reports about the Cuban debt. I know we are selling garbage to honest people. I see the faces of the neighbors I have ruined. I resign today. Not because I have money, but because I still have a soul. Something you clearly lost long ago." But Mitchell saved the best deals for the people at the top. When National City launched a new stock offering, he created a secret preferred lists. Insiders who got to buy shares at a fraction of what ordinary Americans would pay. A stock about to go public at 100, the preferred list got it at 20. Guaranteed profit, zero risk. And who was on the list? Well, former President Calvin Coolidge, Charles Lindbergh, America's greatest hero, senators, the very men who were supposed to regulate the banks. Mitchell was buying silence and protection by handing cash to the most powerful people in the country, disguised as investment opportunities, funded by the deposits of the people these politicians were supposed to protect. But Mitchell still had one vulnerability. One honest newspaper story could bring everything crashing down. So he made sure that never happened. He bought financial journalists with expensive dinners and inside tips on upcoming stock pools. By giving reporters a personal stake in the market's success, he turned the free press into a branch of his own sales force. By 1928, everything was in place. Millions of Americans were invested. The insiders were protected, the press was controlled, the bad debt was hidden. And the one institution that could have stopped it all was about to try. In 1907, a financial panic nearly destroyed the American economy. Banks collapsed and markets froze. The country came within inches of total ruin. So in 1913, Congress created the Federal Reserve to do one thing: step in when speculation spirals out of control and prevent a catastrophe before it happens. And by early 1929, the Fed was terrified. Stock prices were climbing faster than the real economy could justify. Companies trading at 15 times their annual profits, and almost all of it was being bought with borrowed money. On February 6, 1929, the Federal Reserve did exactly what it was created to do. It issued a direct warning to every bank in America. Stop issuing loans for stock speculation. The market is overheated. This has to end. And the market listened. Stocks began to fall. Interest rates on margin loans shot from 12 to 20%. Billions of dollars evaporated in days. For a moment, it looked like the system was working. The bubble was deflating slowly, carefully, the way it was supposed to. The Fed was finally doing its job. And then, on March 12, 1929, one man decided he was bigger than the United States government. Charles Mitchell called a press conference. He stood in front of the cameras and in front of the entire nation. He told the Federal Reserve to go to hell. National City Bank will provide the market with all the liquidity it needs, he declared. "We have $25 million available today and it will be loaned. We will not allow a crisis to occur." Mitchell was announcing that his bank, his money, his rules would override the central bank of the United States of America. And the market believed him. Newspapers ran the headline, "Sunshine Charlie saves the market." And within a week, every dollar of losses was recovered. Stocks didn't just stabilize, they exploded to new all-time highs. The correction was dead. The party was back on. But here's the detail that is nothing less than shocking. At the exact moment Charles Mitchell made that announcement, he was sitting on the board of directors of the Federal Reserve Bank of New York. He was part of the institution. He was supposed to enforce its decisions. Instead, he went to the press, contradicted the central bank's orders, and dared them to stop him. The public trusted Mitchell more than they trusted the government, and Mitchell knew it. He had made himself a sovereign power. But not everyone was fooled. One broker wrote to his client that week, "Mitchell was in the papers again today, grinning and telling us there is no cause for alarm. Whenever that man smiles, I buy gold. He's a Pied Piper leading a nation of children towards a cliff." But warnings like this were drowned out by the tidal wave of optimism Mitchell had unleashed. Fear disappeared, caution died. When people believe they can't lose, they stop thinking. Mitchell had created 10 million true believers, and he knew with absolute certainty that every single one of them was wrong. He had read the internal reports. He knew the Cuban loans were rotting. He knew the investment trusts were hollow. He understood better than anyone alive that the entire foundation was sand. And here is what Mitchell had actually done. He had flooded the market with 10 million people buying on borrowed money. He had personally overruled the only institution trying to slow it down. And by keeping the cheap credit flowing for 7 more months, he had inflated the bubble to a size where its collapse wouldn't just hurt investors, it would destroy the entire economy. Mitchell had built a time bomb, and he knew exactly when it would go off. So why did he stand before the nation and promise that everything was fine? Because he needed time. Time for the insiders on the preferred list to move their fortunes to safety. The 10 million Americans who trusted his word had no idea what was coming. And what followed will later be called the false summer. To everyone watching, Mitchell had been right all along. The Dow Jones climbed from 280 to 381 points. Euphoria was peaking. People weren't investing in companies anymore. They were investing in Mitchell's promise that prices could never fall. Joseph Kennedy, the father of the future president, was getting his shoes shined when the shoeshine boys started giving him stock tips. Kennedy sold his entire portfolio that afternoon. "When shoeshine boys are giving you stock advice," he said, "it's time to get out." An internal memo from one of the trading pools captured exactly how the game worked. "We move at noon. We will pump the volume to create the illusion of interest. Once the public follows Mitchell's morning statement and starts buying, we liquidate our positions quietly. Let the retail fools hold the bag." Their favorite target was RCA, Radio Corporation of America, the Nvidia of its day. Brokers on the trading floor performed like actors, driving the price up while paid journalists wrote glowing articles. And then they'll pull the rug. Ordinary Americans trying to ride the momentum were left holding nothing. The same mechanics as GameStop just 90 years earlier. By October, the insiders were out. The smart money was gone. The only people left were the ones who believed that Mitchell had told them. They had no idea what was about to hit them. October 22nd, reporters asked Charles Mitchell for his assessment of the market. His answer: "I see nothing to cause alarm." 2 days before Black Thursday, he knew exactly what was coming, and he lied anyway. That same day, a very different message traveled through National City's private telegraph network. An internal flash bulletin to the bank's own traders. Maintain the appearance of confidence. Tell clients the bank is buying, but ensure that every sale order from our private account is executed before the retail orders hit the floor. 2 messages, one for the public, one for the insiders. The customers were told to hold. The bank was getting out. Thursday morning, October 24th, the opening bell rang at 10 a.m. Within minutes, prices were falling so fast that the brokers on the trading floor began screaming. Men grabbed each other by the collars, punching through the crowds to reach the trading posts. The roar from inside the New York Stock Exchange was the sound of 1,000 men realizing all at once that they were losing everything they had. The ticker tape was designed to print 285 characters per minute. It was the mechanical heartbeat of Wall Street. The sound had become so constant, so inescapable that doctors had given it a clinical name, the ticker tape neurosis. And that morning, the heartbeat was dying out. With 13 million shares being dumped in a single session, the ticker fell behind, first by minutes, then by hours, and by noon, it was running 4 hours late. Brokers were selling at prices they thought were current, only to discover their clients' holdings had been wiped out hours ago. One floor trader wrote in his diary that night, "We are trading in the dark. We sell at a price only to find out the real price was 50 points lower 2 hours ago." By 11 a.m. an enormous crowd gathered outside on Broad Street. Estimates put it at 10,000 people. They weren't shouting, and they weren't rioting. They stood in almost complete silence. A policeman stationed at the entrance later recalled, "Every time a window opened on an upper floor, a gasp went through the crowd. They were waiting for bodies." Inside the brokerage offices, a millionaire stood completely paralyzed in the middle of the room, holding a fistful of ticker tape, sobbing like a child, repeating 5 words. "It's gone. It's all gone." One woman saw the collapse coming. She called her banker at National City and ordered him to sell her entire portfolio. The bank refused. She called again. They refused. By the time they finally acted, her holdings were gone. And then, the bank demanded she pay them for the losses. Suddenly, she owed them money. At noon, the most powerful bankers in America gathered in secret at the offices of JP Morgan directly across from the exchange, and Mitchell was among them. They pooled their money to buy stocks in a coordinated performance designed to restore confidence, and for a few hours the bleeding stopped, but it was a band-aid on a bullet wound. Tuesday morning, October 29, Black Tuesday. When the opening bell rang, the chaos was so extreme that witnesses said you couldn't hear the bell over the screams. 16 million shares traded by the closing bell, a record that would stand for nearly 40 years. The ticker tape didn't stop printing until 7:45 that evening, nearly 5 hours after the market closed. Witnesses described the sound not as a steady click anymore, but as a high-pitched mechanical scream that wouldn't stop. In a single day, Americans lost $14 billion, more than the entire economy of Canada at the time. And as the sun set over lower Manhattan, the dominoes that Mitchell had spent a decade stacking began to fall. First came the margin calls, telegrams arriving on kitchen tables across America. Your account is under-margined. Unless the amount is deposited in cash within 16 minutes, your entire portfolio will be sold at market price. No further notice will be given. The banks didn't wait. An internal directive at National City made the priorities clear. Our primary obligation is not to the individual solvency, but to the bank's protection. If a margin call is not met within the hour, liquidate immediately. Do not listen to pleas. A mechanic from Detroit had put 6 months of wages into Ford stocks. When the bank demanded money he didn't have, he hanged himself in his garage. As prices collapsed, stocks became worthless as collateral, banks stopped lending, credit dried up overnight. When people rushed to withdraw whatever they had left, the vaults were empty. The money had already been lent out to the same people who had just lost everything. 9,000 banks across the country simply locked their doors. People standing in line outside never got their money back. The crash was over, but the depression had just begun. Mary Cafield was a school teacher from Ohio. She had taught for 30 years. When National City salesmen came to her town, they told her the bank's bonds were as safe as government gold, and she believed them. She convinced her elderly parents to mortgage their family home to buy Radio Corporation stock. After the crash, the bank seized the house. 3 generations of her family were put on the street. She wrote a letter directly to Charles Mitchell. I trusted your bank because your name was synonymous with the flag itself. I bought the stock you recommended at $4.50. It is now worth $20. I am facing retirement with nothing but debts. Was it all a trap? For people like me who didn't know better? She never received a response. In a garage in New Jersey, police found a handwritten note. My dearest Eleanor, I cannot come home tonight. The margin calls have taken the house, the car, and the children's savings. I listened to the men in the silk hats. I believed them when they said the market was fundamentally sound. I am a failure as a husband and a father. It's better that you have my life insurance now, before the banks find a way to take that too. In New York, lines formed not just at banks but on bridges. The Brooklyn Bridge became a monument to despair. Police were stationed there around the clock, and when bodies were pulled from the East River, officers noted a recurring detail in their reports. In the pockets of the dead, they found stacks of worthless stock certificates. And what was Charles Mitchell's response to the millions of people he had destroyed? His answer was always the same. He was sorry they had lost their money, but ultimately, they were the ones to blame. After all, they shouldn't have gambled. While the Depression was destroying lives across America, a very different story was unfolding behind the doors of National City Bank. 2 weeks after Black Tuesday, Mitchell's board of directors held a secret meeting. They established a special fund, $2.4 million. In today's money, roughly $45 million. Interest-free loans to the bank's top 100 executives, so they could cover their personal stock losses. Years later, investigators discovered that virtually none of these loans had ever been repaid. The bank had quietly transferred them off its books and buried them in a subsidiary's balance sheet. The executives kept the money, the customers went bankrupt. But there were other employees at National City. The clerks, the tellers. Employees were encouraged to buy National City stock. And by encouraged, I mean was required if you wanted to keep your job. Bank clerks signed agreements, pledging automatic deductions from their salaries to pay for shares at $2.30 each. When the crash came and the stock collapsed to $25, these employees expected some relief. After all, the executives have just received $2.4 million in interest-free loans. They got nothing. Mitchell forced them to keep making payments toward the original price, $230 per share, for a stock now worth $25. Every week, 40% of their paycheck was automatically deducted. One clerk sent an internal memo to Mitchell's office. I am begging for a suspension of my stock payments. I was told purchasing these shares was mandatory for my career advancement. Now the banks deduct 40% of my weekly pay for a stock that is worthless. I cannot buy milk for my infant daughter. We are living in the dark because I cannot pay the electric bill. How can the bank report millions in profits, while its own clerks are starving in the shadows of the vault? The response from Mitchell's administration was 4 words. The contract must be honored. 2 rule books, one for the men at the top, one for everyone else. Executive 2.4 million in interest-free loans. Quietly forgiven. Buried in the books. Clerks, 40% of their wages garnished for worthless stock, no exceptions, no mercy. And for 4 years after the crash, nobody knew any of this. The internal memos, the executive loans, the widow hunting, the preferred list, the 2 sets of rules, all of it buried. Until a man with a photographic memory and a stack of subpoenas came to Washington. By 1933, America was on its knees. 1 in 4 workers was unemployed, thousands of banks had failed, families were starving in the streets, the country demanded answers. The Senate hired a man named Ferdinand Pecora to find them. Pecora was the son of an Italian immigrant. He smoked cheap cigars, he had a photographic memory that terrified every witness who sat across from him. And he had spent months gathering documents that were never meant to see daylight. On February 21st, 1933, Charles Mitchell walked into the Senate hearing room, tanned, rested, fresh from Bermuda, as if this whole investigation was beneath him. Across the table sat Pecora, calm, patient, with stacks of internal memos, victim letters and bank records piled in front of him. Pecora began with the bonus system, the structure that incentivized salesmen to push worthless securities onto unsuspecting customers. Mitchell tried to defend it. "Yes, I feel quite strongly about it," he said. Pecora's response was surgical. "Doesn't it also inspire a lack of care in the sale of securities to the public?" Mitchell stumbled. "I can readily see from your viewpoint that it would seem so. At the time, I don't recall seeing it operate that way." "You wouldn't," Pecora replied. "Only the customers would see it after they got the securities." Then Pecora reached into his stack and pulled out a letter. A woman had just buried her husband. She had received a life insurance payout, and a salesman from Mitchell's bank learned about it and targeted her specifically. He convinced her to invest every cent into Cuban sugar bonds, the same bonds Mitchell's own internal memos had called hopeless. Pecora read the letter out loud to a silent room. Mitchell tried to deflect. "If I go and buy a pound of coffee, there is no indication as to what the grocer paid for it, or what profit he got." Pecora leaned forward. "But when a person goes to a store to buy a pound of coffee, he knows the merchandise he is buying, doesn't he?" Mitchell had no response. Mitchell's final words to the committee would define his legacy forever. "We are merchants of securities. The investor should know what he's doing." Merchants of securities. The life savings of school teachers and widows were inventory to him. If the coffee was poisoned, that was the customer's problem. The hearings lasted 10 days. By the time Mitchell walked out, Sunshine Charlie was dead. In his place stood something new, a word invented during these very hearings. Bankster. Time magazine put it on the cover with the headline "Damnation of Mitchell." He was forced to resign in disgrace. He was later tried for tax evasion. During the boom, he had sold stocks to his own wife to fabricate losses and dodge $850,000 in taxes. And the evidence was overwhelming. The verdict? Not guilty. Charles Mitchell never spent a day in prison. And National City Bank, it didn't just survive, it thrived. The government declared it too big to fail. The collapse of smaller competitors allowed it to absorb their assets for pennies on the dollar. By 1935, it controlled an even larger share of the market than before the crash. Mitchell faded into obscurity and died in 1955 at the age of 78. He never acknowledged any responsibility for the Great Depression. In the aftermath, Congress tried to make sure this could never happen again. In 1933, they passed the Glass-Steagall Act. It forced a wall between commercial banks and investment banks. The boring businesses of holding people's savings would be separated forever from the Casino of Wall Street speculation. They created the Securities and Exchange Commission to police the markets. They established deposits insurance. They set strict limits on margin trading. America looked at the wreckage and swore, never again. And that wall lasted 66 years. In 1999, Congress repealed Glass-Steagall Act. The banks were free again. 9 years later, the global economy collapsed. Banks had repackaged worthless mortgages and sold them as safe investments. Different names, different instruments, same mechanics. Mitchell's playbook updated for a new century. And today, the echoes are everywhere. 50 million Americans trade stocks through apps on their phones. Margin debt has hit 900 billion, the highest in history. Apps like Robinhood promised the exact same thing Mitchell promised a century ago. Democratize finance. Everyone can be an investor. This is your chance to get rich. A new generation is investing in crypto and meme stocks on borrowed money, with borrowed confidence, believing, just like 10 million Americans believed in 1929, that this time is different. Charles Mitchell has been dead for 70 years, but the machine he built is still running. Every American should be a capitalist, Mitchell said in 1928. Everyone should invest, they say today. The Great Depression didn't happen because of bad luck. It happened because a system was built to transfer wealth from ordinary people to the men at the top. And when it collapsed, the men who built it walked away free. The people who trusted them paid for a decade. Next time you hear promises of easy money, next time you hear someone tell you that the old rules don't apply, next time a smiling face on your phone screen tells you that this time is different, remember Sunshine Charlie and ask yourself one question: who will really profit?